What does the Reserve Bank's latest interest rate decision mean for our housing markets? What's going to happen to interest rates moving forward? And have our housing markets now bottomed? That's what we're going to discuss in this week's Property Insider video. If you want to keep up to date with what's happening in our housing markets, please subscribe to this channel and click that little bell icon so we can keep you updated each time a new show comes out. The Reserve Bank has brought to an end its record-breaking streak of interest rate hikes. It hit the pause button in April, and it's now waiting for more economic data to see whether inflation is coming under control quickly enough. Now, we know that interest rates have a significant impact on our property market. It affects borrowing capacity, affordability, and in particular, consumer sentiment. So what does this decision mean for our property markets, and what's ahead for interest rates? That's what I want to ask Dr. Andrew Wilson, Australia's leading independent housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, good day, Michael, and happy Easter to everybody.
Yes. Well, economists were split on whether the Reserve Bank would pause interest rates in April. Forecasters were unsure whether all that spate of economic data signalling a slowing in the economy would be enough to stave off another hike. But I know you had your views on what went ahead.
I'm not sure about all this data, Michael, that shows our economy slowing. I still think we're full steam ahead and operating on 8 cylinders. It was a very strange decision, in my opinion. In fact, I think most economists were predicting another rise, basically on the fact that the Reserve Bank continues to tell us that its decision would be based on the data as it came through. And that clearly wasn't the case for the April decision, because the March data that we received was unequivocally strong again, except perhaps for some sideways movement in terms of the monthly inflation data. But even then, the easing in inflation was more about those adjustments on the supply side, lower fuel costs, less of a mismatch between demand and supply, rather than anything sort of significant in terms of reduced demand. I mean, consumption was still strong, which is not a surprise given that we still have a record low unemployment rate. Hello, isn't the most significant, I guess, indicator of reduced demand would be a higher unemployment rate? I mean, that's what we've seen generated through previous periods of higher interest rates. In fact, if that's the case, we're going in the wrong direction, because we had another record low unemployment rate over February, 3.5%. We had over 60,000 jobs created. We had a fall in the number of unemployed. And we also had another very high participation rate, which meant, and it was higher, which meant people were coming out of the population and back into the workforce. So nothing in any sense a guide to a weakening economy with that labour market data. It was just quite ponderous, the reasoning behind the Reserve Bank's decision. It's almost as though they blinked and that they were starting to get concerned about the stress that higher rates were causing. Well, it's supposed to cause stress. That's the whole point of it, to stop people spending. And when we speak about spending, retail sales were higher again over February. So, there was just no support for any sense that interest rates that, as you said, have been increased 10 consecutive months had any impact on the economy, as per the model of the Reserve Bank that it keeps spouting. It's just another flip-flop from the Reserve Bank. And I'm not sure what they do going forward now if we start to or continue to see a strengthening economy, or certainly an economy that's still holding at very high levels, particularly in terms of the labour market.
The Reserve Bank, Andrew, suggested that it could be more pain to come. It suggested further rate hikes could be on the way to break the back of the rising inflation. But I think the flip-flop, as you correctly called it, is going to only create more consumer concern. It'd be nice to know which way things are heading rather than on again, off again.
The whole point is, Michael, that consumers have shrugged off higher interest rates. There's just no sign of reduced consumer activity other than those woolly consumer sentiment surveys, which tend to always be completely the opposite to what the data shows us. But look, retail sales are higher, unemployment rate record low. And guess what? House prices are rising again, Michael. Now, surely the real issue with higher interest rates would be creating an anchor to the housing market. But quite the opposite. We've seen housing markets reviving over the last 6 months. And now we finally have, even though prices were falling through that 6 months period, the rate of decline was easing. And now the trend has clearly continued and we have prices increasing. We had house prices higher in all the major capitals over March. And Sydney's now recorded consecutive higher house prices. And we're not the only ones that are measuring that. This is a consistency with all the data measures. So this is good news for the housing market that's already clearly in revival mode, that they don't have to worry about another interest rate increase. Their March meeting, they did promote perhaps the idea that they would consider putting interest rates on hold. I thought it was just a bit of a throwaway line saying, well, we might do this and we might do that. We might put them up. We might have them on hold, But they did clearly say we'll wait for the data to come through. Now, in that March meeting, there was perhaps some signs with the unemployment rate just rising slightly, the trend for retail sales perhaps easing a little bit. But that was all out the window when we got the February data, Michael. It was just unequivocally strong. And yet the Reserve Bank decided to go ahead anyway and pause without the guidance of the data. So it's just as though they're putting their finger up to the wind or throwing a dart at the dartboard to decide what monetary policy will be. And as I said, I don't think there's any doubt that interest rates will have to rise again if we are to control inflation. And isn't that their main game, other than perhaps now they're thinking, well, we don't want to be apologising again for making another mistake, which is, that's confounding to a large degree. And we're now entering this up and down phase of interest rate policy. And I'm not sure that the lack of consistency is a good thing when we're trying to quell demand and get rid of the highest inflation since the 1990s.
Well, you suggested that now there's going to be extra consumer confidence for our housing markets. Clearly, there are many factors driving them, not just interest rates. And an important one is consumer confidence and, of course, supply and demand. So some people are asking, has the housing market bottomed? Maybe before I ask you that question, my thoughts are there isn't a housing market. There are multiple markets around Australia. And the bottom isn't a day. It's really more a process, isn't it? But there's clearly evidence that some of the markets have moved to the next phase of the cycle with your My Housing Market data, Andrew.
Well, it's not just our data, Michael. Most data models are now showing prices increasing. So any sign of that peak to trough type of decline, which a lot of the negative Nellies have shifted to in terms of their forecasting, well, I can throw that one out the window too, because we've moved past the trough, particularly the national housing market, which of course reflects basically what's happening in Melbourne and Sydney. I think clearly we've moved past the bottom, Michael, and the portents are positive that we will continue to grow. And this just hasn't come out of left field. It's been something that's building now for a number of months.
Well, a lot of it has to do with supply and demand. Lots of extra people coming to Australia, putting pressure on our rental markets, but also on our housing markets. And we're just not getting enough supply. Unfortunately, with builders going down, there's going to be a further hindrance of the growth of new dwelling supply of houses. And with the apartment market, which we require to fill in bulk in large quantities accommodation for all the new migrants, they're just not financially viable at the moment.
No, and I mean, look, we're celebrating Easter at the moment, Michael. Easter typically signals the end of the first part of the autumn selling season. Of course, we do have a break for Easter. There was only a handful of auctions conducted on the weekend, so we don't have any auction results that are of any significance this week. But it gives us an opportunity to look back and assess what's happened with our markets before we get into the second part of the season, which commences this forthcoming week and will run through until basically the Queen's birthday long weekend. But it's been a very positive beginning to the market. We've already alluded to higher prices, but we shouldn't be surprised at that because clearance rates have risen from the mid to high 50s where they finished last year generally and have now moved where we had the final weekend before Easter. All capital cities recorded, or the auction capitals, all recorded clearance rates above 70%. With the exception of Canberra. So that really tells us the evolution and the revival of our housing markets through the early part of the autumn selling season. Why should we be surprised that house prices are higher? Because that relationship always holds. So it's been a very positive start to the year for the housing market, despite those higher interest rates. And it does make a nonsense of a lot of the consumer confidence measures that are out there. And I think that there's plenty of momentum going forward, Michael. And I think the most important part of or sector of that momentum is fear of missing out, because even though we've seen consecutive increases in the Sydney median house price, the first increase in Melbourne over March for nearly a year, yet prices in both Melbourne and Sydney, prices are still 7% lower than where they were a year ago, despite those increases. And in Melbourne, prices are still around 5 to 6% lower than where they were a year ago. So for buyers, they'll be clearly thinking, well, prices are rising now, so the market looks to have bottomed, and I'm now considering the opportunities that are there to buy at a discount compared to where property prices were a year ago. And this is a very similar dynamic to what we saw in early 2019, when housing markets were in a similar fragile, or come through a similar fragile environment in terms of confidence, but it started to bounce back because of those value perceptions. And I think value perceptions will drive the Sydney and Melbourne markets going forward, not just, as you've mentioned, Michael, the imbalance between supply and demand, which is clearly there. And now we don't have an interest rate increase to worry about, and wages are still rising at the strongest rate in 10 years. We still have a lot of trouble matching jobs with people because we just don't have enough workers out there. So this is obviously pretty positive about that the second part of the autumn selling season will again be as positive as the first.
Well, one of the leading indicators, something showing which way the markets are heading, are asking prices, and something that you had been monitoring for many, many years. And they're also suggesting that moving forward, we're going to be having a better time in our housing market. Consumer confidence is picking up a little bit. Lending activity is still strong. There's a whole lot of indicators. So we're not just talking about one factor, are we? There's actually very little vendor discounting. Days on market are still strong. So there's multiple pointers that the housing markets are going to do better this year.
Reserve Bank, in its statement on monetary policy for its meeting, which it released on the day, of course, the full minutes will be out shortly, which will be interesting to read, still mentioned that lower house prices or falling house prices were part of the moderating effect on household balance sheets. Yeah, okay. When are they going to bite the bullet and say, well, house prices are rising again? They're notorious bears on the housing market, the RBA. They've got it wrong so many times in terms of their outlook. And I think perhaps there's been a little bit too much focus on the potential outcomes in the housing market when it's come to where they've placed monetary policy. And I particularly look back to 2017 and 18 in terms of when we had interest rates on hold for a record period of time. Look, that's another story, but it certainly is another factor which reflects the fact that consumers are out there spending, and not just on retail. They're now spending on houses and units, which are obviously big ticket items. Now, the other point for the Reserve Bank, Michael, is I don't think there's any doubt that the US will raise rates again in their forthcoming May meeting. The latest jobs data, a little bit down out of the US, but still very strong. I don't think there's anything there that would encourage the Fed to hold rates. So we're now moving in a different direction to the rest of the world, or certainly similar central bank policy, which will put downward pressure on our dollar for a start, but exporters won't be too worried about that. But nonetheless, it's, again, the Reserve Bank, strangely out of step with what's going on in other jurisdictions where their interest rates are higher, and they're obviously continuing to meet the challenge of high inflation with higher interest rates, which is, I thought, was the policy.
I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice, because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Well, the Reserve Bank meets each month. It doesn't really know what's going to happen. It looks at all the data, looks at its current policy and makes a decision. But the money market has spoken and is suggesting that interest rates aren't going to rise any further. And the big four banks, and we know they haven't got a particularly good reputation in predicting interest rates, they've all lowered their expectations of how high rates could go. Interestingly, all the big four banks are now predicting another interest rate rise eventually, and the market, the interest rates will peak at 3.85%. And then they're all suggesting that interest rates are going to drop, but at various levels and starting at various times. So the market seems to think that there's only one or maybe two interest rate rises ahead, Andrew.
I wouldn't be listening too hard to the money market or the banks, Michael, given their history of success in terms of forecasting. It's quite laughable, in fact, but just don't make decisions on it. And I think that the fact is that we're now seeing a breakout in the price of oil is really sobering news for the prospects of inflation. Again, bank forecasts, they change with the wind, and the money market, well, who could believe that anyway, because they're consistently wrong with their outlooks, but they don't care because they're just looking for a margin. But we've now got OPEC deciding to reduce production of oil. That will put upward pressure on oil prices, even though oil prices are half of what they were a year ago when they peaked at over $120 US a barrel. And as I said, they're now floating around 80, but it's still well ahead of where oil prices were pre-COVID. So they're still relatively high. And now we have OPEC deciding to cut production, which can only surely mean higher prices, and that higher fuel costs are always a driver of inflation because they have such significant downstream impact. And you only have to do, Michael, is have a look at the cost of petrol now in Australia, at the Bowser, and it's started to push up towards $2 a litre again.
I thought that was just because of the Easter holidays, Andrew, but the Reserve Bank is really hoping that inflation is going to come down this year, but there are a number of factors that are going to drive it up, and another one's rents, isn't it?
Yeah, no easing in rents, as we discussed recently, Michael. The latest rent report was a horror story again. Just, when you're looking for some relief, even if it's just a steady result over a month, it was actually another very strong increase in rents over March, and particularly from units, as you've mentioned before, very strong increase in units. In fact, I think we're going to see unit rents in Sydney reach parity with house rents, and that'll be around about $700 a week. I think that will be the median asking house and unit rent over April, although April is obviously a holiday month. We'll wait and see the outcome there. But yeah, rents are continuing to rise, and of course, the Reserve Bank again got that wrong, and they've been promoting some woolly theory that the reason rents are rising is because household numbers are falling. So therefore there are more households, and this will eventually readjust. Well, good luck with that. I'm not sure how the simplicity of supply and demand in terms of underbuilding and high levels of migration, it seems to be ignored by the Reserve Bank as a clear catalyst of why we have skyrocketing rents. But nonetheless, we do, and they will continue, only moderated by the capacity of tenants to pay more, and that means what their increases are in incomes. There's just no joy going forward in the rental market, Michael, and for tenants, and I think that's only going to add to inflation going forward.
Well, the Reserve Bank will meet again on the first Tuesday of May, and at that time it will have the March quarter CPI figures that are coming out at the end of April, around the 26th of April. Of course, they're going to be very backward looking, and we know there's a lag between when interest rates go up and the market is affected by them.
Yeah, I thought it was interesting. We do have those quarterly data sets coming out. As you said, Michael, what value are they? Because they're looking back 3 months. It was interesting that the Reserve Bank referred to as the one, I guess, hook that they could put their hat on in terms of interest rates working was those monthly inflation numbers. And yet it's not that long ago when in their statements, they referred to those monthly ABS inflation data as experimental, something that, they just sort of look at ho-hum and because it's a work in progress, which it is. So, and now and then in the latest statement, they were saying, well, we look to those monthly figures and that's part of justifying our decision to put rates on hold. Don't get me wrong, rates on hold is a good thing. But the question here is the integrity to some degree of the Reserve Bank's decision-making. And if it's now going to move from a period of up, down, or steady up, I think the whole point is that you have to create, if this is the policy position, you have to create that momentum to reduce demand. You can't be turning the tap on and off, Michael. It just has a delaying effect and only puts out the horizon, sends out the horizon when you might actually get inflation under control. We shouldn't be surprised that the significant review of the Reserve Bank is now underway with the Commonwealth government. Gee, there's lots and lots to talk about there, is there not?
Well, I remember reading that there's a Chinese saying, may you live in interesting times, but I also remember reading that that was a curse, not actually a good wish. And yes, we do live in interesting times. So I look forward to catching up with you again next week and discussing what's happening to our economy and our housing markets, Andrew.
Yes, Michael, that'll be good. And we begin the second part of the season. So it'll be interesting to see what our results are next weekend in the auction market.
See you then.